Ben Bernanke used to say that monetary policy is 80% communication and 20% action. And what the Federal Reserve is doing is a lot of communication, play in with the market, basically hinting at the idea of enormous rate cuts and then sort of saying it's going to happen next month. Don't worry, it's going to happen next month, and then delaying it further. More importantly, at the same time, it is giving the impression of being hugely restrictive when in reality, the Federal Reserve is being massively accommodative. If we look at the latest FOMC statement, what we see is that the Federal Reserve is delaying quantitative tightening. And delaying quantitative tightening, despite whatever Mr. Powell may say, is easing. Why? Because it's very evident at the end of the day, if the pace of reduction of the balance sheet of the Federal Reserve is reduced, and reduced massively because it's going to be less than half what it was originally thought, they're basically saying three things. Number one, the Fed is going to prioritize liquidity over inflation, over the battle against inflation. Number two, the Fed is worried about the insane level of deficit spending that is going to make that the Treasury issues more debt than what the market demands. And therefore, it fears that bond yields are going to rise way too high, and with that, a significant slump in markets. Number three, what the Fed is also worried about is the situation with regional banks in the United States. Not just regional banks, but all of those parts of the economy that have the highest level of impact to a slump in sovereign bonds. Therefore, after another episode of bailout of a bank in recent weeks, what we have to understand is that the Federal Reserve is actually very concerned about a slump in the bond market that comes when the bond market has not recovered from the decline of 2022. So, the Federal Reserve is prioritizing liquidity over the battle against inflation. Inflation, at the same time, is accelerating both on a 3-month basis and on a 6-month basis. And those elements, if the Treasury, if the government continues to have an enormous deficit, what is going to lead is to a fiscal problem at some point in 2025. And that fiscal problem, what the market is discounting, will be solved with more easing. Hence, what the market is simply doing is looking at what is going to happen in 2025. And in 2025, probably another very aggressive level of easing. Those things, an accommodative Fed, and the risk of easing in 2025, despite elevated inflation, show us the risk of stagflation, but show us why we should be avoiding those sectors that are in need of a decline in inflation, a rapid decline in inflation, and rate cuts. And also be very aware of the risk in those parts of the bond market that are very, very close to having negative real yields.